Yeah, and I think we need to make a separation between the US economy and the stock market just for a moment here. So basically the US economy has been chugging along reasonably well, particularly if you can put it up against the other economies around the world, Europe, Japan, China, Canada for that matter. It's been growing fairly well, not spectacularly, but fairly strongly. Again, you've got massive deficits, so you have 7.5%, debt to deficit to the GDP. So it's had a lot of stimulus, and that's resulted in some reasonable growth down there. And so when we look at that, I mean, the stock market has reflected that and more. Valuations are at higher levels. We all know that the average S&P 500 stocks are trading at 23, 24 times earnings, which is fairly close to a high. And so valuations are rich. And the economy's been, I think, as I say, reasonably strong. Our issue is that valuations in the stock market already reflect a very rosy picture, and that the rest of the world is not doing that well. And so we think the stock market generally will go sideways, if anything, and it'll be a lot harder, tougher slugging